All right, hello everyone. Welcome to our discussion of cash flows and how we set them up. We do cover how to do cash flow statements in Accounting 150 very basically by using the accounting equation worksheet, and again in Accounting 161, which is in some detail there. So this is really the third time, but we do all the financial statements more than once. This is multiple times with the other ones as well. Cash flows tends to be give students some of the most difficulty. So we do want to make sure that we go over it multiple times. Before as we jump in here with the basics, there is an example uh, using the information given after this explanation. So you can go through this, and then you can actually see it done as you work on that. So typically, although there's nothing that says you have to do a cash flow statement in a particular order, but typically we start with the operating. But before we actually get into the three sections, operating, investing, and financing, let's talk about what we're trying to do with cash flow statement. That is to explain the change in cash. So really the first step is to calculate this change in cash. That's how you'll know you have accomplished what you need to accomplish on the cash flow statement, is when you have operating plus investing plus financing cash flow adds up to the change in cash. That's the goal. We are learning the indirect method. That only impacts the operating section. The investing and financing, there is only one way, but there is two ways to do operating cash flow. We and everybody else in the world does the indirect method. There is a direct method which calculates various pieces of how much cash is paid. It's more difficult and tends to have need information that is more difficult to find to complete. So the default is the indirect method, and so that's what everybody uses. So the indirect method, we take the income statement and then we adjust it to be cash flow from operations. So by definition, we start with net income. We take net income off the income statement. So that would tell us we need an income statement before we can, for the year. So the same year we're going to do the cash flow for, we need an income statement for that. We need net income. How's we start? Then we make three types of adjustments to net income to turn it into cash flow from operations. The first one is we take out any non-cash expenses or revenue. So if you had a non-cash revenue, you would subtract it. If you have a non-cash expense, you would add it. The most common of these is depreciation, amortization, those types of expenses. But there are other non-cash. There are stock compensation. We provide employees with stock instead of cash. Those can all be non-cash expenses. Those would be added. Much more rare is non-cash revenue, but if that you came across where that was the case, that would be subtracted. So generally, you're going to add back those cash expenses right from the income statement. You may have to do a little investigation, but you should be able to tell from your income statement what your non-cash expenses are. Add them back. Then you're looking for gains and losses. If there are no gains and losses, and remember, gains and losses are unusual items, things outside of our normal course of business. So there very easily could be no gains and losses. But if there are, you're going to subtract gains and add losses. You always do the exact opposite of what you did on the income statement, because you just need them to go away, because they don't impact cash flow, or at least the gain or loss does not impact cash flow. So we just need to get them out of the income statement by adjusting them away. So subtract gains, add losses. All right, the most involved step, the one that takes the longest, is the changes in operating assets and liabilities. Quickly, the definition of an operating asset or liability is one where changes to that asset or liability impact net income. That's the technical definition. Typically, what our assumption will be is that current assets and current liabilities are operating assets and liabilities, unless we have a reason to believe otherwise. And there are some, and there'll be a couple in your example that are don't follow that general rule. But if we have no further information, given to us, then we're going to go with current assets and current liabilities are operating assets and liabilities. So the easiest thing is just to put them side by side, two balance sheets, and go down the current assets and current liabilities and look at the changes. All right. And the general rule, and then you can adjust from there, is that if it is an asset and it goes up, that is required cash. So you subtract increases in assets. If you can remember that, then you can always think, then if I subtract increases, then I must add decreases. And then liabilities are the opposite of assets, so liabilities should work the opposite way. So you're going to add increases in liabilities. Think of borrowing more money, and subtract decrease in liabilities. Think paying money back. And if you do that with all of them, just put in positive. Now on the cash flow itself statement, you should indicate whether it's an increase or a decrease rather than just putting pluses and minuses. But as you're building it, you may not feel like you want to do that. At that point, you can come back and tidy up those types of formatting issues as you go through it. So that's your operating section. Do a subtotal that starts with net income. Okay, adds your non-cash expenses, subtracts the gains, adds the losses, and then all the changes in operating assets, and you get your cash flow from operations. That's your most important thing. That is what companies have to be able to be successful at. They need positive cash flow from operations. Otherwise, they're going to be in trouble. They cannot consistently have negative cash flow from operations, or they're going to go out of business because they're literally losing cash every minute they're open from doing their operating activities. Okay? That moves on to our second and third section, investing and financing. Investing has to do with long-term assets. Notice, cash paid for long-term assets, cash received from the sale of long-term assets. Typically, the two types of long-term assets, those that depreciate, buildings, okay, equipment, that sort of thing, and those that don't, like investments, okay, securities, those do not. And if you're talking about those that depreciate, you have an added complication with the depreciation, the accumulated depreciation. Typically, it's going to be pretty easy to figure out how much cash was received from the sale of these long-term assets. You can usually look that up, that information. Cash paid for long-term assets, you may have to go into a little bit of a more involved process. That's shown in a spreadsheet just below this in what we call the difficulties. The cash paid for long-term assets is one of those because we need to separate it from the sale of the long-term assets. If we have both in a given year, a sale and a paid of property, plant, and equipment, for instance, then we have to pull it apart. We have to look at T accounts. We need to consider what the journal entries were for the purchase and the sale. Because what happens when you sell Property, plant, and equipment is property, plant, and equipment goes down. When you buy it, it goes up. So if you put them side by side and you just see a change, you can't really know what happened exactly, because it may have gone up, but that may be because it went up more because of the purchase, but they also had a sale. Okay? Or it may go down because they sold more than they bought, but not because they didn't, they did one or the other. Okay, so we need to separate them out. That's the requirement under GAAP. Okay, so that's what we got to do. There's some explanation of how to do that exactly, but still we want the assets, these long-term assets, side by side, because that's our starting point, is to see how much did it change, and then finding the differences. Now, a little added complication with property, plant, and equipment that depreciates is if you see on the balance sheet net, meaning it's already subtracted out the depreciation, you have another thing that could change that changes it, and that's depreciation. And the sale of an asset also reduces accumulated depreciation. All right, so moving on to financing, this has everything to do with borrowing or paying back non-operating liabilities. Okay, investing is long-term assets. Remember, current assets are generally operating. Investing is long-term assets. Operating is current liabilities. Financing is long-term liabilities or non-operating liabilities. So we're literally going to consider everything on the balance sheet. Financing also has to do with equity, stockholders' equity, selling stock, buying back stock, treasury stock, and dividends, all of which we've talked about how those work out from the journal entry standpoint earlier. So now we're looking at the cash impact. When we sell stock, we're just going to sell it for cash. That's going to be one of the easier ones. But remember, when you sell stock to shareholders, you're going to impact both common stock and additional paid-in capital, or paid-in capital in excess of par, or whatever you call it. Both of those. That is the credit. So you need, when you look at that, you need to consider those two things on your balance sheet together to see how much cash you received from selling stock. Remember that when we buy stock, since we've already gone over the statement of equity, we know that we impact treasury stock. And the sale of treasury stock affects that account. Okay? Not common stock. So you're looking at the treasury stock comparison to figure out how much was paid for treasury stock. All right. Dividends impact retained earnings. So you would normally look at your income statement and expect your retained earnings to go up by the amount of your net income, which we've already included in our cash flow. But if there's dividends, it's not going to go up by the amount of the net income. It's going to go up by less. And the amount that it's going to go up compared to net income is how much they must have paid in dividends. Because as of now, that's the only two things that impact retained earnings, net income and dividends. Now, when it comes to borrowing or paying back loans, we need to be careful of a couple things. First of all, they may classify some part of the loan as current portion. So whenever you see that on a balance sheet, consider the current portion and the long-term debt pieces as one. Just add them together. Okay, they need to be separated for balance sheet purposes, but for cash flow, they're the same loan. And so when looking at the cash paid or amount borrowed, look at them together. Just like when we buy and sell assets, that we need to consider the fact that we could have borrowed and paid back loans. So if we see a difference side by side of our note payable or long-term debt after we've added in the current portion, we see it's gone up. It may not be that we just borrowed that much, the difference. It could be. That could be the only thing that happened. But typically, we're borrowing some and paying some back, because we've usually got more than one loan, right? And so maybe one loan we're paying off and the other loan we're borrowing a new one. So we need to consider what that is and separate them out. Again, look at the T accounts and journal entries. That's another one of the complicating factors in the cash flow is those long-term non-operating liabilities, paying them off. And then last, so we've got an investing cash flow and a financing cash flow. If it's cash, if it's a positive, it's cash from. If it's negative, it's cash used in. But again, those are the kinds of things you can kind of fix up as you get ready for your final draft of your cash flow. Once you've made it work with the numbers, you can go back and tinker with the wording. Okay, another tinkering that has to happen is every cash flow needs to have what we require 2 required disclosures, or some people would say 3. The FASB kind of lumps those second 2 together. But first one, non-cash investing and financing. These are pretty rare. I've only seen a handful in cash flows statements I've read over the years. But every so often, a company will say, for instance, convert their debt into stock. Well, that's a financing activity that doesn't involve any cash. Their debt is going to go down, or stock is going to go up. That's 2 changes, and they're usually going to be significant changes. Because you're going to do this, you do it in a big way. But it doesn't have anything to do with cash. So you would see the difference on the balance sheet, but there would be no corresponding thing in the cash flow. Very, very confusing for the reader who's trying to check and see how everything works together. And so you put this there to tell reader, yeah, we had a big change in, and they need to be material. They need to be big items, not small, because there's all kinds of small non-cash investing or financing activities that no one cares about. But if it's a significant one, then it needs to be listed as what happened. So if you converted preferred stock into common stock, if you converted debt into stock, if you bought a asset with stock, all right. The biggest one, typically, that can happen more often, is when we use leases to buy assets, and often there is no cash involved. All right, so that could happen. That's sometimes considered common enough that everybody kind of expects it to happen anyway. And so there's not that much disclosure, because there's a whole bunch of lease disclosures, as we'll get into in a few weeks, that help us understand that. So you don't really need to repeat that in on the bottom of the cash flow. All right. The cash paid for interest and cash paid for taxes, kind of the same idea. On the income statement is the expense for interest and the expense for taxes, sometimes called the provision for taxes. But it's basically tax expense, income tax expense. That's not necessarily how much cash was paid. You start with the expense on the income statement, but then you adjust it for interest payable or taxes payable on the balance sheet. So if you have $100 as income tax expense on the income statement, then you look at the balance sheet, and income taxes payable went from $30 down to $20. That means you paid more in income taxes than you recorded as an expense. That's why the payable went down. It went down by 10. You take that, you add that to the expense on the income statement, and your cash paid for taxes are actually 110. It's almost never going to be the same as on the income statement. If your income tax payable goes down, then you add that to your tax expense, and if it goes up, you subtract it. And the same thing happens for interest. You start with interest expense, You look at interest payable on the balance sheet. Take the comparison. If it goes down, you paid more for interest, cash paid for interest, and if it went up, you paid less. Those are required disclosures that go at the bottom of every cash flow statement.